So something just broke in the global bond market, and it is being massively underreported. Japan's 10-year government bond yield just hit 2.43%. That is a 27-year high. The last time it was this elevated was February 1999. And it is not just the 10-year. The 5-year yield just hit an all-time record at 1.84%. The 2-year yield climbed to 1.395%, a 31-year high. The 40-year yield is now sitting above 4%. The entire Japanese government bond curve is repricing at once, and that is extremely unusual. These are not normal market moves. Now Japan holds $1.2 trillion in U.S. Treasury bonds. Japan is the single largest foreign holder of U.S. government debt on the planet. And when Japan's bond market gets this kind of stress, the U.S. bond market does not get to sit quietly in the corner and watch. It never does. That is just not how this works. Now the situation Japan is in right now is coming from two sides at once. The dollar has surged 3% on the back of the Iran conflict. Every time there is a geopolitical shock, the world's first move is to pile into dollars. Safe haven reflex. That 3% dollar move sounds manageable until you see what it did to the yen. The yen cracked 160 to the dollar. Now, 160 is not just another exchange rate. It is the line in the sand. Japan's finance ministry just warned publicly they will take all necessary measures to address what they called speculative and highly abnormal currency movements. That is the language governments use right before they intervene. And the last time Japan intervened in the currency market, they sold close to $100 billion in U.S. bonds to fund it. Keep that number in your head, because we are going to come back to it. Now, at the same time, oil is up 50% since the Iran conflict started. West Texas Intermediate is above $110 a barrel. For most countries, that is a bad situation. For Japan, it is a structural emergency. Japan imports 90% of its oil. Every barrel comes in from overseas, at a price Japan has zero control over. And because the yen is weaker at the same time, paying for that oil is even more brutal. One analyst put it well this week. Oil at 110 feels more like 130 or 140s for Japan once you factor in the currency hit. Japan's business confidence just posted its worst reading since the pandemic. Bankruptcies are rising. It is genuinely not pretty over there right now. Now the textbook answer to a currency in freefall is to raise interest rates. Higher rates attract capital, the currency stabilizes, the bleeding stops. Simple enough in theory, but Japan cannot do that without opening up a much worse wound. Japan's national debt is over 200% of GDP. That is the highest of any developed economy on Earth. Their debt servicing costs, just the interest payments, forget the principal, are already projected to hit 41 trillion yen by 2029. That is 30% of the entire national budget, just to service the interest. And the bond market is already pricing the 10-year yield, rising to 3.6% by 2029. And that projection was made before the energy crisis even started. Every rate hike right now just pours more weight onto an already collapsing structure. Now, markets are pricing a 70% probability that the Bank of Japan hikes anyway at their April 28th meeting. A former BOJ official came out this week and said the central bank will probably raise rates this month to avoid falling behind on inflation. And honestly, when you hear that, it is a little alarming, because the inflation Japan is dealing with right now is coming from a conflict on the other side of the world. Raising rates does not lower oil prices. It does not reopen Hormuz. All it does is make Japan's debt burden heavier and squeeze businesses and households that are already hurting. Just sit back for a second and think about what that looks like in practice. You are running the Bank of Japan. You hike rates and your debt servicing costs spiral out of control. You do not hike and the yen keeps collapsing, and imported inflation destroys consumer spending. You intervene in the currency market by selling U.S. bonds, and you trigger a crisis in the U.S. Treasury market. Every option you have makes something worse. That is the corner they are in. And the rest of the world is going to feel the consequences of whichever choice they make. Now, for years, Japanese institutions loaded up on U.S. Treasury bonds because yields at home were near zero. The return on U.S. paper was simply better. That made sense when Japan's 10-year yield was at 0.25%. It makes a lot less sense when Japan's own 10-year is at 2.43% and the 40-year is above 4%. Why take the currency risk on U.S. paper when you can earn almost the same return on your own bonds at home? One strategist said it bluntly this week. Japan has been the world's financial shock absorber for a generation, and that role has abruptly ended. That is not a small statement. Now there are two ways this plays out, and both of them are bad for the U.S. The first is the slow version. Japanese investors simply stop buying new U.S. treasuries. No dramatic sell. They just let existing holdings mature and redirect that cash into domestic bonds. Quiet, gradual, almost invisible until it is not. But the U.S. desperately needs buyers right now. The national debt just crossed $38 trillion. Trump is pushing for a military budget of $1.5 trillion. The deficit is on track to exceed $2 trillion this fiscal year. There is a $10 trillion refinancing wall the U.S. has to get through in 2026. If Japan quietly walks away from the buyer's table, that refinancing gets significantly more expensive. And there are not a lot of other candidates queuing up to replace them. The faster version is a direct sell-off. And this is the one that changes everything overnight. Japan's finance ministry has already signaled it is ready to stabilize the yen, and selling U.S. bonds is on the table. Japan did exactly this in 1997 during their own financial crisis. They know how to execute it. And the last time they intervened, they sold close to $100 billion in U.S. bonds in a single operation. Now imagine that happening while the U.S. is simultaneously trying to roll over $10 trillion in debt, while inflation is running hot, while the Federal Reserve is debating whether to hike rather than cut. The U.S. 10-year yield is already at 4.41%. The 30-year is approaching 5%. The last time the 10-year broke above 4.6% during the tariff standoff, the Trump administration reversed course within hours. The S&P was down between 15% and 20% at that point, and the system simply could not take more pressure. And that was a cleaner environment than this one. Right now, everything is stacked. Energy crisis, fiscal deterioration, Federal Reserve under pressure, Japan running out of options. You do not need all of these to blow up at once. Just a few of them moving in the wrong direction at the same time is enough to trigger a serious market event. Now, let us also talk about the Federal Reserve, because they are in an uncomfortable spot too. The February CPI was 2.4%. That reading does not yet reflect the full energy impact from the conflict. March and April data will be worse. The market now prices a 40% probability that the Fed hikes this year. The Fed funds rate could end 2026 at 3.75%. And that completely kills the strategy Scott Bessent has been running at Treasury. Bessent's plan has been to issue short-term debt to keep borrowing costs manageable and avoid locking in high long-term rates. Smart enough in theory. But if the Fed hikes short-term rates, short-term bonds reprice immediately. Rolling over that debt gets more expensive overnight. Investors holding longer-dated bonds demand higher yields because the fiscal picture keeps getting worse. The Pentagon alone wants an additional $200 billion for the military effort in the Middle East. That is more bond issuance on a market that already has too much supply and not enough willing buyers. You genuinely cannot spin your way out of that math. There is no narrative that makes those numbers work. Now, the yen carry trade is the piece of this story that tends to get ignored until it is too late, and then suddenly it is all anyone can talk about. So, let us get ahead of it. For years, investors borrowed yen at near zero rates, converted to dollars, and parked the money in U.S. stocks, U.S. bonds, higher-yielding assets globally. The return was strong, and the funding cost was almost nothing. Morgan Stanley puts the outstanding carry trade position at around $500 billion. Other estimates go as high as $1 trillion. Nobody has the exact figure. But we all saw what happened in August 2024 when the BOJ raised rates by just a quarter point. The Nasdaq dropped 13% in 3 trading days. Global markets collapsed at the same time, and that resolved quickly only because the BOJ immediately walked back the rate signal. The BOJ cannot do that this time. The inflation is real. The pressure is real. There is no walking it back without allowing the yen to collapse further. When the carry trade unwinds, investors sell their best-performing dollar assets first. U.S. tech stocks, U.S. equities, corporate bonds. Then they buy yen back to repay the loans. The yen strengthens sharply. That forces other traders to unwind their own positions. It feeds on itself, and it moves fast. The August 2024 episode with just a quarter-point hike caused a 13% NASDAQ crash in 3 days. The current setup is far more stretched than that was. The same mechanism with a much heavier load on it. That should worry everyone holding U.S. risk assets right now. Now do not lose sight of the oil situation, because this is what is driving everything, and it is nowhere near resolved. Even with the ceasefire announcement earlier this week, a senior Iranian official said elements of the deal were already breached before it was 72 hours old. Iran continued to largely block the Strait of Hormuz, and Trump's response to that was to talk about escalation. Just listen to this. Sometimes you have to escalate to de-escalate. Now, when you hear that framing from the president managing the world's reserve currency during an active energy crisis, it is really something. Escalate to de-escalate. That is not an off-ramp. That is a signal that more operations are coming. And the numbers back that up. The U.S. has already moved nearly all of its JSSM cruise missiles from Pacific stockpiles to Middle East facilities. The number drops from 2,300 units to just 425. You do not move your missile stockpiles halfway around the world if you are preparing to wind things down. Now, if this conflict escalates further and both Hormuz and Al-Mandeb close simultaneously, you are looking at a supply shock with no modern comparison. Hormuz carries 20 million barrels a day. Al-Mandeb carries another 4.3 million. Russia was 11% of global oil production during the Ukraine conflict. The Middle East is 25% to 30%. The potential disruption here is simply in a different category, and oil at extreme supply shocks has broken past $150 a barrel before. It happened in 1980. It happened during the Arab Spring. It happened during the Russia-Ukraine conflict. The difference now is the scale of the supply chain exposed. J.P. Morgan ran the numbers on what sustained high oil actually does to the U.S. economy. West Texas Intermediate at $120 a barrel produces a 2% rise in inflation. That same scenario produces a 1.25% contraction in U.S. GDP. Now layer a 15% fall in U.S. stocks on top of that, and you wipe out another 3% of GDP growth. Add those together, and you are looking at a contraction that could very easily tip into recession, depending on where other variables land at the same time. Now look at where the U.S. economy already stands before any of that additional damage hits. The hiring rate just fell to 3.1% of total employment. That is down nearly 500,000 positions compared to a year ago. And those were February numbers, before the conflict fully fed into the real economy. Imagine what March and April look like when that data starts coming in. The CPI readings for those months are going to be genuinely uncomfortable. Inflation that was supposedly cooling down is about to spike back up, and the Federal Reserve is going to have no good options when it does. Now Wall Street is still remarkably calm about all of this. The S&P is down only 4% year to date. Tech stocks down only 6%. The market is essentially betting on a phone call, a handshake, Hormuz reopening, everything going back to normal. And honestly, that optimism is a little bizarre considering what the signals are actually saying. Iran's foreign minister said publicly that Tehran has zero faith in negotiations with Washington producing a real result. That is not ambiguous language. And then you have Trump out here talking about bridges. We'll hit some bridges. We've got a couple of nice bridges in mind. If they come to the table, that'll be good. It doesn't matter whether they come or not. And when you hear things like this from the person responsible for the world's reserve currency, it is genuinely alarming, not in a dramatic TV way. In a real, practical sense. What fund manager hears that press conference and decides today is a good day to add more U.S. Treasury exposure? What central bank looks at that and thinks, yes, this is the safe haven I want to increase my allocation to? The credibility damage is real, and it accumulates quietly, drip by drip, until suddenly it doesn't. Japan's 27-year bond yield high is the clearest signal yet that the architecture is changing. Japan was the silent buyer of last resort for U.S. debt for a generation. For decades, Japanese institutions absorbed U.S. paper that nobody else wanted because yields at home were too low to bother with. That dynamic is gone. Japanese yields are now competitive. The incentive to hold U.S. paper at the expense of currency risk is evaporating, and the energy crisis is adding a completely separate pressure on top of that, forcing Japan to think about liquidating what it has rather than buying more. Now the April 28th BOJ meeting is the next key date to watch. Watch what Governor Uedo signals on the rate path. Watch the yen. If it breaks clearly and stays below 160 per dollar, intervention comes. And that means U.S. bonds on the market. Watch the 10-year U.S. Treasury yield. If it touches 4.6%, the Trump administration faces the same impossible choice it faced during the tariff crisis. And this time, there is no easy reverse. The energy crisis does not pause for a post on social media. The bond market does not stop because someone says something calming at a press conference. The yen carry trade does not unwind in slow motion. It unwinds in an afternoon. That is not a metaphor. That is what August 2024 showed us, and that was a much smaller trigger than what is building right now. There is still no price in the stock market for a Japan-driven yield spike. No price for $500 billion to $1 trillion in carry trade positions unwinding at scale. No price for the Fed hiking while oil stays above 110. Every one of those risks is live in the system right now. And the longer the conflict drags on, the bigger the final bill gets. We have no idea how ugly this gets if the math stops working all at once. So, let me know what you think. Will Japan be forced to sell U.S. bonds to save themselves? And is the global financial system anywhere near prepared for what that triggers? Let me know in the comments below. Stay safe, smash the like button, and subscribe as we navigate through these crazy times.